So our next topic is very exciting, new laws in estate planning. So our panel members are Mark Dutram with Bayview Private Wealth, Luke Smith with BluePoint Financial, and Jane Kerrigan with Hand Arendall Harrison Sale.
This is a topic you all signed up for. This is the most exciting one, I guarantee you. Yeah.
Certain. Starting it off. Okay. Hello, everyone. Luke Smith, BluePoint Financial. I'm taking, as we're going through the last 3 tax acts that we've seen in the past 2 years, and going to touch on the estate planning issues. Obviously, there's a lot more to these acts that we could be here, like we've said before, all day talking about each individual one. So, going to try to keep it to estate and trust related issues as much as we can. And then some pieces of it will obviously be related to individual situations. So I'm going to talk about the TCJA, the Tax Cuts and Jobs Act that was passed in December of 2017. Most of these pieces of this act started in 2018. So you've probably already been affected by most of it. So, excuse me. My mouth dry. So the first thing in the estate and trust arena is the tax brackets. You know, you're pretty familiar with the individual tax brackets. There was a change to that as well, but the biggest change is in the estate and trust tax bracket. And the big part of that is, thank you, is the top tax bracket. So in an estate and trust, if they have income, they're needing to file taxes, then the income is a very big piece of planning opportunity to save dollars for the estate and the trust for the beneficiaries. As you can see, or my slide here, I think we'll get up there, but it's the top tax bracket in a estate or trust is $12,600. That's 37% tax at that point. Of course, as you know, it's a progressive tax bracket system. So any money over $12,600 is then going to be taxed at 37%. In relation to the individual tax bracket, the married filing joint bracket, highest bracket is $622,000. So there's a big, huge difference between the two. So there's, you know, the different types of trust that we have out there. Perfect, thank you. So we've got, you know, if it's a simple trust, you know, most of the time those income dollars flow through to the beneficiaries, where we're going to get the tax benefit of paying at a lower rate. But if you got a complex trust, those dollars may stay in the trust, and that's where you're going to see a huge difference in taxation between the money flowing through to the beneficiaries and the money staying in the trust. And you know, as there's not a whole lot. At $12,600, you can get there pretty quickly. And at the same time, some of these things, some of the income that comes through a trust, it could possibly be zero tax if it passes through to the beneficiary. No, that's the pointer.
Yeah, the bottom.
Sorry.
It's okay.
One of these places.
Yeah.
Anyway.
The bottom button?
Yeah.
It's not working? Oh, hang on.
All right.
Let me, I know why.
Gotta engage it.
That's all right. So in that, where I mentioned that the tax or the income passing through to the beneficiary in a capital gain situation, the individual rate for married filing jointly could be 0%. So 0% tax up to $77,000 of income. So if the situation presented itself where the tax stayed in the income stayed in the trust, you may be paying 20% on that, where if it passed through to the beneficiary that might not have a lot of other taxable income, they wouldn't pay any tax. So you can easily see the difference there in tax savings and planning needed with your attorney and financial advisors to know those tax implications so you can make the best decision, and with the goal of keeping as much funds as possible. Let's try that again. There we go. All right, so a couple other things that I wanted to also touch on is in the TCJA, the charitable donations. Typically, it's been a limitation of 50% of your AGI. That changed to 60% for cash donation. So if you have a little more giving personality, to this would be the time to do it. And Mark is going to talk about the CARES Act, which also changed it as well.
Right.
And it's it comes out to be, what, 100% of your
100%.
AGI. So if you are charitable inclined, now is the time. The tax savings is as big as it's going to be. And that, I believe that goes through the end of the year for the CARES Act. So couple other small things that, in this that some other pieces that might hit or affect us on the trust and estate side. The financial advising fees, they're no longer deductible as a miscellaneous itemized deduction. That has caused some heartburn for sure when they come to see me and they ask me, why can't I deduct those fees? So I say, go talk to Mark about that. I'm sure he'll work something out.
Thank you, Luke.
Yes.
Thank you, so.
So there's another thing that was in the TCJA that can affect estate plans is on the divorce side. If you have a divorce, alimony and being expensed and taxable is no longer in effect after 12/31/18. There was also an increase in the ABLE account where you can contribute more than the annual contribution or annual gift of $15,000. And Mark was going to touch base a little bit on that for us to give us a little bit of understanding what the ABLE account is and how that works.
Would you like me to?
Sure, go right ahead.
So the ABLE account, again, is a great way for those with special needs to be able to qualify still for government benefits. So if they had SSI or if they had Medicaid or things like that, it's an account that's kind of an exempt asset up to a certain point that, again, you could put funds into and, still provide access to, capital for spending, everyday life, which people with disabilities have. So what this has done is actually allowed you now to not only contribute the $15,000, which, by the way, you can have yourself do or family members, but now if that person is still working, and matter of fact, we have a client whose daughter's still working and is able to now contribute up to $12,000 to the ABLE account and still, qualify for tax-free income. Another thing you could do is 529 plans. So 529 plans can now be rolled over into an ABLE account, and instead of just being able to use those funds for tax-free for education, now they can use them for a much broader scope of spending from the ABLE account. So very good there. And then they're also maybe eligible for a saver's credit, right, for making a contribution to their own ABLE account if they're working. So lots of good expansion that came from. Anybody have ABLE accounts in here? I mean, Florida has a great ABLE account, and if you need more help on that, either text in on the chat, right, or chat in and ask questions. We'll be glad to help, and anybody in the audience.
Thanks, Mark. So another big, huge piece of this, and this has changed everybody in the room's thoughts on a lot of how estate and trust planning is done, is the increase in the estate and gift lifetime exemption. So it's always been around $3 to $5 million per person. With the TCJA, it jumped up to 11.2 per person. So then 22 for a couple. So that is a big increase. I mean, you see a lot of estates, with some good planning, they could easily get to $5 million range here, over a lifetime. But with this exemption, up to 11 million, it certainly helps the thought of, hey, am I going to have an estate tax? And it has changed how we, draft estates and those kind of things, or trust. And it kind of has made it a little bit easier for everybody, just having that big exemption, because just the amount of people over that obviously is not as large. So that has been one of the bigger changes for our industry since 2018.
If I could just make a comment on that too. I mean, those of you that have done trust, I remember, gosh, in the 2000s where it was $675, right, for the exemption. Those of you that did trust years ago may necessitate some amendments to those trusts where you were trying to plan for estate tax exemption or things like that, the old AB trust, the bypass trust credit shelters, you might now want to rethink how you've structured those documents. So see somebody like Jane, you had to go in and talk about those kind of things.
And yeah, I would say that's one of the biggest things that I see is when people bring old trust into me, not only is the exemption up, now we have portability, so you don't have to equalize the estates.
Right.
We can simplify a lot of the planning that was done, which if it doesn't get simplified, they come in and they say, what do you mean my husband's share is in this irrevocable trust that I now have to file tax returns for and things like that. So.
Right, that's great.
So certainly, it has been the biggest change, and is the need for everyone to review what might have been done in the past, because just as Jane said, you might have some unintended consequences that you're not expecting. So, a couple other big things that came out in the TCJA was the qualified opportunity zone. Was set up to encourage some additional investment into lower income areas of the country, but it also provides anyone that might have a taxable capital gain some way to reduce tax liability, and that can be in a trust. It doesn't have to be just an individual. But you are investing any portion of a gain that you might have, it is deferred. The tax on it is deferred. So, as an incentive to do this, the IRS or the TCJA has put in place is that at year 5 of your investment into this opportunity zone fund, you get a step up in basis. And then in year 7, you get another step up in basis. So at year 7, you have to recognize the gain, but you get a 15% step up in your basis. So you're saving a pretty decent amount of tax on that, depending on the size of the gain that you want to roll into this fund. You can do that with it. Most any financial advisor is going to have some idea or product of opportunity for this. So then the other great thing about this, so if you put your gain in at day 1, at year 10, if you've kept the funds in that fund for 10 years, any appreciation on the initial investment is tax-free as well. So it can certainly be a good opportunity to defer tax and then also save on some tax-free income. Of course, it's as the current environment of investments and things go, it might not necessarily be the best investment, but it's something to certainly weigh. In most cases that I've seen, there is some substantial tax savings if you have a large enough gain that it's worth locking that cash into this investment.
Yeah, I can just make a comment too. I think as of the end of 2019, there were over 9,500 opportunity zones. And similar to SRI investing or ESG investing for a long time, again, that's socially responsible or environmentally conscious types of investing, you had to sacrifice return, really. There wasn't that great of returns to justify kind of the altruistic type of investing that you would do in those things. But today, again, with many more opportunities, you get kind of a dual benefit, right, of helping a lower socioeconomic community, and then at the same time So essentially, it kind of works like a 1031 exchange for a while, right? Where you're
That's right.
reinvesting back in, but eventually with this one, at year 10, you could have the potential to wipe out the capital gain altogether, which is pretty cool. And there's funds out there, so opportunity zone funds that actually will aggregate investments for you that are professionally managed. So yeah, it's actually a very good.
If you have rather large gains, there are opportunities for you to set up your own fund as
Sure.
well too, which certainly gets a little more complicated, but that is an option. A couple other things on the TCJA that I thought were going to be pertinent to our discussion today relate to the retirement plans, and then also the CARES Act and Secure Act expound on that as well. But the TCJA, they were put a few things in place, extend time to repay loans, and then also some of the changes to the IRA. Usually when someone comes to me, they're doing their taxes, we don't see that they've made an error by contributing to a Roth IRA until it's too late. So now in the TCJA, they're not letting you just go right back to the traditional IRA with those funds. So if you made more, there's an income threshold where you can't contribute to a Roth IRA anymore. You usually could just be able to recharacterize that to a traditional IRA, and they've put some barriers in place to do that. So that is kind of the summary of the TCJA that does relate to estates and trusts, and obviously there's a lot more to it. One of the biggest pieces of it that I've seen as a CPA that has benefited a lot of individuals is the small business owner. The qualified pass-through income deduction was a huge benefit, and certainly if that's something that you have seen or have a small business, then hopefully you have been able to take advantage of that as well.
Love it. I'll jump on to
There we go.
the CARES Act. A lot of these things are the result of the times that we're in. I mean, certainly the CARES Act was an attempt to provide liquidity, right? So there were many things that gave you more access to your funds with less penalties and much easier. And then obviously a ton of fiscal stimulus, right? So CARES Act, most of the time when you think of that, you think of PPP loans, and you think of EIDL loans and things of that nature, and unemployment benefits. So it was a result of a pretty serious time. So we could spend, many days talking about the beautiful thing of CARES Act. But so we're going to try to narrow it down just for the topic of maybe planning and certainly kind of estate benefits, right? So the first thing I had, let's see if I can use this thing here. Yeah, so just kind of a summary there. So coronavirus-related account distributions, again, more access to your money in a more favorable way during a challenging time. Required minimum distributions waived, we'll cover that real quick. Student loan payments deferred, the AGI limits. As Luke talked about, they expanded those deduction capabilities in the TCJA, but now it's even more in the CARES Act. And so basically you could access, right? I think you also have the capability of doing a loan from your 401k plan. And it used to be 50% of the value up to $50,000. Now, again, it's even $100,000 in some expanded time periods of paying that back. You can also do a distribution. So even prior to 59 and a half, if you were, again, COVID affected, right? So you were somehow, whether it was employment, whether it was family, whether it was a sickness, you were COVID affected, you have access up to $100,000 of your IRA assets without the penalty that you would have normally had. And then they're going to do, I always looked at this as kind of like when they brought out the Roth, where they're going to give you time to pay the tax bill. So you actually have up to 3 years, right, to put the money back in, and then you have 3 years really to kind of pay the tax bill. Luke, talk about that a little bit, would you, about how that tax bill may come?
This is similar if you've seen some of the hurricane relief that's come through the area. It's a similar benefit as that. So you have the opportunity, if you took $100,000, you have the opportunity of paying tax over a 3-year period on that money. If you don't plan on paying it back. There's a certain form you file with your tax return. It's going to spread that out where you're only going to have 1/3 of that tax, of the distribution to be taxable in the current year, which is certainly a great benefit, because if we're needing those funds, you don't really need that tax dollar to come out of there right away. So there's no withholding requirement either. So, and most of the time, like I said, if you're needing that fund, you need it all. So this helps lighten the load of the tax burden. And then if you wanted to pay, if you recover, get some money, and you wanted to pay that back, then you can recontribute that money. And then if you recontribute it by the time you file your next tax return, there's no issue. But if you recontribute it in year 3, then you would need to go back and amend your tax returns to get that refund of the tax that you paid on those funds.
So a little bit maybe of a process, almost like when you do a rollover and you have the 20% withholding, you have that opportunity to put it all back in, but you may have to go back and refile to get the taxes that you prepaid, if that makes sense. But yeah, so essentially you could have had those funds, used them for 3 years, put them back in, had no penalty, had no tax consequence to that entire situation. So again, all of this as a kind of a COVID-related event for somebody to have access to their money, right? Required minimum distributions, right? And I think Jane will even talk about some of this expansion. But if you're in RMD status, that's required minimum distribution, and you're required to take that percentage out, they waive that for 2020. And so even if you took it out, you had the ability to put it back in by August. So if you took it out, and again, if they did some type of withholding on it, on your distribution, you could actually go and file and get that back. Right now, it would serve as a credit, right, to the IRS for taxes that are due. But if you put it back in, you could get those taxes back, again, when you file your tax return. So just another way of giving people access to funds during a very challenging time. Student loan payments, the same thing, right? So they initially deferred them for 60 days, then they postponed them to the end of the year. So set the interest rate to 0, no payments were due, and so again, just a greater access to capital to let people navigate a very, very challenging time. AGI limits. So as Luke talked about, again, with the TCJA, they had increased it from 50% to 60%. Well, now it's 100%, right? And so you essentially could wipe out your entire tax bill if you were charitably inclined. Think about the motivation here. When things are rough, charitable giving goes down. And so they thought, hey, this is going to be kind of like a dual purpose here. We'll encourage charitable giving again, and we'll give people some advanced tax credits and the abilities to do that effectively. So what this is doing is you actually have a carry forward now. So even if you gave more than your AGI limit, right, you can actually carry that forward for up to 5 years. So just trying to encourage charitable giving, which is actually a pretty good thing to do if you were going to do it anyway. Now it's a little bit more favorable. Even with yours, right? So that, the losses, so that, like I said, so many things in this bill for businesses, and so there's actually carry back now, even for, remember, losses that people had, they could carry them back for 18, 19, and 20. So yeah, many more things. The ABLE accounts we kind of talked about. Great account, just ABLE, you had to have had the onset of the disability prior to age 26. So you could still get an ABLE account after age 26, you just would have had the disability happen prior to that time. And again, great account. Florida has a very good one, and those monies are invested, and as long as they're used for qualified spending, you can still qualify for government benefits, and then at the same time have tax-free earnings and returns on that ABLE account. It's a little bit about Roth conversion. Jane's going to get into a very good topic about conduit IRA standalone trusts and things of that nature. Well, we even talked about a little of this in the first panel. with the Secure Act now limiting the amount of time that a beneficiary can take distributions from an IRA, that might change your plan. And I hope you're getting from these conversations that your estate plan is not static, right? It needs to be adjusted over time due to changes in your family, but also changes in the tax law. So Roth conversions now may make a lot more sense. I was reading something the other day that 89% of the time, taxes are higher than they are today. 89% of the time. That's staggering. So pretty good indication that tax rates are probably going to go up in the future, especially as much fiscal and monetary spending as we've seen actually take place, right? So with Roth conversions, you know, obviously you're thinking about accelerating a tax bill for you guys, right? If you're going to do this conversion to a time that's now, right? So you're controlling when you actually pay that tax bill. So just be conscious about when that's going to be, right? Is it more favorable now, or would it be more favorable later? And Roths in general, I always love the term, would you rather be taxed on the seed or taxed on the harvest? You know, with a traditional IRA, you're going to be taxed on the entire IRA. With the Roth, you're just taxed on, again, the amount that you put in there. So if you're going to pass on assets to next generation, right, that might be a great reason, and all the more when we talk about the Secure Act, that, again, that might be a Roth conversion opportunity because you're going to pass on then a tax-free asset to them, right? So something to think about. Will my kids be in a higher tax bracket than I am? Am I going to be in a higher tax bracket later? Will the marginal tax rates be higher than they are today? I mean, all of those things kind of go into your planning of whether you want to do a Roth conversion or not. And there are great calculators, by the way, online that will calculate, you know, the break-even point. If you do a conversion, obviously you're going to have to pay that tax bill now. And, you know, how long is that going to take you to break even before it makes sense for you to do that? And again, kind of like Luke talked about earlier, if you're going to do a conversion, we always say pay the tax bill from outside of the IRA. You're removing a lot of its benefit if you're actually going to pay the tax bill from the account itself. Also, Luke talked about, you know, you have income limits for Roth contributions. There is such a thing as what's called a backdoor Roth, where you can actually make again, a after-tax contribution to an IRA and then convert that to a Roth. And of course, there's no income limits for an after-tax contribution to a traditional IRA, which would also then give you the ability to convert it. The only thing you have to watch out for is what they call kind of the step doctrine or aggregation rules with regards to how that's rolled over. But if you have a planner, again, they could help you with some types of ways of that. So as long as you have earned income, right? Again, you can continue to make contributions. And now, with both the traditional and the Roth, you can make contributions now past 70, which it used to shut that off. That was fun, wasn't it? I mean, that's Secure and the CARES Act. That's good. All right, we're going to jump into Jane for the Secure Act.
May I have the clicker, please?
Yes, please.
Thank you.
You need it.
So, as Mark said, we're now at the Secure Act, which went into effect on January 1st, 2020. It is actually the Setting Every Community Up for Retirement Enhancement Act, which comes up with Secure. It was signed by President Trump into law December 20th, 2019, became effective January 1st, 2020. And it does have some provisions that are going to affect your retirement assets. So your IRAs and those types of assets are affected by this act. The first thing it did is it increased the required beginning date for the required minimum distributions from 70.5 to 72. It also repealed the maximum age for contributions, which Mark just mentioned, to traditional IRAs, and it allows for a penalty-free withdrawal of $5,000 for each parent in the year of a birth or adoption of a child. So if you have a child, you can take $5,000. But the biggest change that we're here to talk about today as it relates to estate planning is the stretch. So traditionally, you could leave your IRA to your children And those children could stretch that IRA out over their lifetime. So that could, essentially, we're just kicking the tax down the road. And so it's a way to defer tax and pass that asset on while it continues to grow to your children. And a lot of times, a lot of estate plans that I see with clients that come in is their IRA is a lot of times the biggest asset that they have. And so that's another thing, when you're doing your estate plans, make sure you talk to your planner about, hey, this is an IRA, or so we know to plan for those appropriately. Because as I think Dina mentioned in the first talk today, that beneficiary designation is going to control over whatever your will says or whatever your trust says. It's that beneficiary designation. So that's just a little aside. But what the Secure Act did was limit the ability for the stretch. So they've limited the stretch to a 10-year stretch. So if you are leaving your account to your children, it is now, they can stretch for 10 years, and after that 10th year, they've got to take it all out and pay whatever tax is left. And that applies to almost every beneficiary. There are certain classes of beneficiaries that doesn't apply to, so we'll go through those. The first is a spouse. The spouse still has the right to stretch out the IRA or to roll that IRA into their IRA and have essentially complete control over that and put off RMDs until they turn 72 and all those great benefits the spouse has. The other individuals is a minor child. A minor child doesn't have to start the stretch until they are of age, or if they are continuing with school until they're 26. So if your child goes to college, goes on to additional schooling after college, by the time they're 26, that's when that 10 years starts. So their potential for 36 is when that IRA would ultimately have to be cashed out. It also applies to a disabled individual or a chronically ill individual, or an individual who is not more than 10 years younger than the account owner. So if it goes to a sibling or someone like that. So those are the exceptions to the 10-year stretch rule. Now also keep in mind, if you don't have a beneficiary, or if you have an old beneficiary who is no longer living and that's going to go to your estate, then the 5-year rule is still in effect. So if you named your estate as your beneficiary, or you name a trust that doesn't qualify under certain provisions, that IRA is going to have to be paid out within 5 years. So I think if we talked a little bit about how the traditional rule was that you could stretch out over your lifetime. So many people in their estate plans would have, there's essentially two types of see-through trust. There's a conduit trust and an accumulation trust. And we'll talk about both of those as we kind of go through the talk today. But many people in their estate plan had, if they had a trust, they would have a conduit provision in the trust. And what that conduit provision would do would give the trustee kind of the ability to control the funds, but the beneficiary would have to take the RMDs every year. So that RMD would be paid out to the beneficiary every year. And that stretch would be based on the oldest beneficiary of the trust. So if you had it going to your 3 kids and your oldest kid was 40, the stretch out would be over the lifetime of the 40-year-old. So we see a lot of these trust plans because there's some asset protection. There's some states don't, inherited IRAs are not exempt from creditors. Florida they are, but some states they are not. So there's some asset protection. There's also, in the case of a divorce, are they going to cash out this IRA and give half to the spouse and things like that some parents have concerns with. So we see a lot of these conduit trusts. But so now if you still have your IRA going through that conduit trust, what the Secure Act has done is once that 10 year is hit, the entire account has to be paid out to the beneficiary. So if you have set up a trust, or your plan is that your beneficiary is going to just get a little every year, just what they need, that's no longer what's going to happen. Everything's going to be paid out at that 10-year period. So kind of an example looking at that. So under the old law, the RMD was determined using the beneficiary's life. So if you have a 25-year-old expected to live 58.2 years to distribute that account. And so they pay a little bit of taxes every year. And so now they only have that 10 years. So you can imagine that's really increasing the tax bill for your beneficiaries, and it can push them into a higher tax bracket, which could have other ramifications for them. So that's kind of the same thing. So what do we do? There's not a lot that we can't do to solve this problem, but one thing is, as I often advise, is to name your spouse as the first beneficiary, because there's a lot that you can do, the spouse can do. If you have a non-spouse, you have to take a look at what are you more concerned about. Are you concerned about income taxes? Or are you concerned about creditors or the beneficiary themselves and just, wasting the money, or concerned that it's not going to be around for the grandchildren to have a benefit? So you kind of have to look at, well, what are my main concerns with these funds? And so one of the things you can do is, as Mark was talking about, is think about converting those funds to the Roth and paying the tax now, which could help your beneficiaries immensely as it goes on to the future. Another, and I don't know if you had anything to add over, you kind of went over it.
No, I mean, like I said, we're always worrying who's going to pay the higher tax, right? Because you're trying to minimize that bill either for you or for the next generation. And then, you're doing that strategically, right? So it's not an all or nothing kind of thing. And it could be some that you do piece by piece. So you're managing kind of the marginal tax bracket, right, that you're in. So maybe do conversions up to a certain point. And again, you're doing that for the benefit of taxes, not necessarily you, right? It could be disadvantageous for your spending right now, right, in paying that tax bill. So, but if you're, like you said, whatever your goal is the goal to minimize taxes, or is the goal to actually provide creditor protection for the children or limited access to the children? Yeah, I mean, some of our kids, we may not want to dump that much money on them in a single tax.
So if the option is that you don't want to necessarily have your children inherit all this money in the 10-year time frame, then you can look at an accumulation trust. And an accumulation trust is also a see-through trust by the IRS standards, and it's a little bit more complicated than your traditional conduit trust. But what you can do is accumulate those distributions, and the ultimate payout stays in the trust. Now, the issue that you have with here is what Luke touched on earlier, and we've kind of been talking about all along, is the tax bill. And so as Luke mentioned, if that income stays in the trust, that's going to be taxed at the highest tax bracket if it's over the $12,600. So that can be a huge tax hit and especially if your children are in a lower tax bracket. So that is a huge consideration. There's also some other issues you have to look at, like you can't have a charity named, and there's some other issues with accumulation trust. But I've seen a lot of situations where I have clients that say, look, my child is not responsible at all, and I do not want them to ever get a lump sum payment. I want to make sure that there's money there for the grandkids if they need it for college and all these things. So they say, I don't care about this big tax hit. And so that's a consideration you're going to have to make for what's best for your family if you decide to go with a standalone retirement trust. And typically, I would recommend a standalone retirement trust instead of doing it through your living trust. Mainly, it just simplifies things. So we're very clear on what the retirement benefits and how those are handled versus do we look at these other provisions of the living trust and try and apply those to the retirement section. So that's one way to handle the stretch. The other thing is just simply buying life insurance and an irrevocable life insurance policy to pay that tax. So to help your kids pay that tax, because like we talked about before, it could bump them up into a higher tax bracket for everything and really create some hardships on them. So that's
Yeah, I would just say something too from a planning note. For those of you that don't need the RMDs, right, the requirement of distribution, some of our clients actually take those proceeds and they're actually paying for a life insurance policy, right? Mm-hmm. So it's distributions from that that now are actually paying the tax bill, in the future. And of course, life insurance proceeds are tax-free, right? The death benefit.
Yeah, and if you put if you purchase that life insurance in what we call an ILET, an irrevocable life insurance trust, as long as you have that for 3 years, that all passes outside of your estate as well. So as Luke was talking, right now our exemption rates are really high. So we have the 11.2 index for inflation, but they're set to go back down, and who knows with the election what's going to happen with those rates. So it's something where we could be back in a situation where it's 3 or 5 or those lower exemption amounts. And then the other option to consider, again, if you're charitably inclined, is a charitable remainder trust. And essentially this will allow, if you leave your IRA to a charitable remainder trust, your beneficiaries can get certain amounts paid out to them over their lifetime, but the remainder is going to go to charity, whatever's left in that account. And this is, again, is for those that are charitably inclined or don't think their beneficiaries need all the money, because they're going to get a much smaller distribution usually than they would have had you left it outright to those individuals. So with all this, I guess the take home from my perspective for my presentation is to talk with your advisors, check your beneficiary designations, and understand what they say and what that's going to mean. So if it's, you name your spouse and then 3 kids, then each child's going to get their own inherited IRA, and it's going to be stretched for 10 years, unless they choose to cash it out right away. And so Mark and I were talking about this, and one of the things to keep in mind too is that they don't have to just take the required minimum distributions for the 10 years and then take everything. They can kind of take it out over those 10-year time frames. So it's not a huge hit at the end, but it's still going to be a pretty big tax hit when that 10 years is up. And so then also you want to look at any changes in your circumstances and make sure that everything that you have, all your beneficiary designations, your estate plan, everything reads together and works together in the best possible way for what you want to achieve. And with that, does anyone have any questions?
How are we doing on time? Is that the charitable remainder trust too is a pretty cool option because obviously you're going to get a tax deduction for the present value of the future gift, which is good. So people can use them. Let's say you had a farm in the family that had a very low basis and was producing no income. Again, you could put that into the charitable remainder trust, sell that asset now, avoid the capital gain, and buy something that actually is producing income. Because like Jane said, that trust now is going to produce income for your lifetime. And then, of course, when you pass away, it's going to go to the charity at that time. So has other benefits besides, the charitable inclination.
Yeah, and so you can use the charitable, as Mark was saying, you can use the charitable remainder trust for any asset. It doesn't have to be an IRA. It can be, like you said, an asset with low basis, and you get rid of all that appreciation out of your estate. So it is a pretty neat tool if you're inclined to give to charity and still get that tax benefit.
No questions?
Oh, stop it, please.
All right, thank you, guys.
Hancock Bank and Whitney Bank first worked together in 1918. In 2011, the two banks merged to become one company built on 5 timeless values: strength and stability, honor and integrity, commitment to service, teamwork, and personal responsibility. With this foundation, our mission is to help you reach your dream. One bank, one mission, 100 years in the making. Hancock Whitney. Your dream, our mission.